Welcome back to the Series 7 Study Guide. I'm Franz. I'm the one that put together the 58 audio lessons, and I'm the one you listen to if you've bought those lessons. I'm recording this as well as creating a video that I'm going to be putting on the website because I have some people that want to look at videos of what I'm talking about. I'm not sure how many want to look at it, but I'm going to do that for this episode. We'll see how it works out. I have put together a new bundle of 58 audio lessons, which is over 25 hours of audio instructions, and the bundle now includes the quiz questions for the lessons. There's over 1,080 quiz questions. Really, it's about 20 questions per lesson, but there's a few lessons that don't quite have 20 questions in, such as the introduction, which only has 10 questions, and there's another couple of short lessons that we couldn't get 20 questions out of. So how this works is when you buy this bundle, which is $99.99, basically $100, you will get the audio MP3 files at Gumroad, which you can download to your computer, and you can also use the Gumroad app to listen to those lessons on your mobile device. Your iPad, your Android phone, your iPhone, whatever mobile device you're using, you can use their app, and I have it right here. This is the app. I put a link to the instructions on how to use the Gumroad app. Basically, the Gumroad app lets you listen to the individual lessons by streaming to your phone, or it lets you download all the lessons onto your phone or mobile device and listen to them with them stored so you're not using up your data plan. Now, the disadvantage of downloading them all is you have to download all 58 lessons, and that's going to take up some storage space on your phone because these are 25 hours of lessons is a lot of MP3 or a lot of storage on your phone. So, but you can also download the MP3 files into your computer and then put them into an iTunes directory if you know how to do that. And I'm not going to talk about that. There's plenty of YouTube videos that will teach you how to do that if you want to do that. So what'll happen if you download this bundle, if you choose this bundle, you'll get the 58 audio lessons. And then immediately when you buy this bundle, I will send you an email with a link to the first set of questions for the introduction, and you click on that link. It'll take you to a website called Quizzer, which is working, and you will take the quiz at Quizzer. Once you've clicked that link, you'll get another email almost immediately from me for the next quiz for the next audio lesson. So as you click those links, you'll get the quiz for the next lesson after. I recommend that you start at lesson number 1 and go to lesson number 2, 3, 4, 5. Don't skip around. If you want to study this material, it's organized in a logical fashion. Don't jump around unless unless you want to, but that's unless you have a lot of knowledge already ahead of time. I mean, if you feel like you just need to study certain portions, that's up to you. Anyway, if you don't click on the links, after a couple days, I'm going to send you another email reminding you that you haven't taken that quiz, and you might want to, and I'll give you the link again so you can take the quiz. And if you still don't take the quiz in another couple days, I'll still send you the link to the next quiz. But you can proceed through the quizzes as fast as you want, but just by clicking on those links. Once you get those links in those emails, you can go take those quizzes as often as you like. You can go back and take them again. So my recommendation is before you even listen to the audio lesson that you go take the quiz. Test yourself. It'll show you the results of the quiz when you take it. Listen to the audio lesson and take the quiz again. By doing that, you're going to be thinking about what you need to answer as you're listening to the audio lesson, and then you can track your improvement. Now, the other thing I like about this is I'm able to go in and look at the results of everybody that's taken the quiz, not individually, but as a group. I can look at the individual questions and see what percentage of people that answered that question answered it correctly. And so it lets me get some feedback on what I might need to cover in more detail for the next edition of this study guide. So that's how that works. Now you can still get the 58 audio lessons without the quizzes. I don't recommend it. You can also get a bundle of the 58 audio lessons and the Series 63 as well. That's also $100 or $99.99. So that covers that. I wanted to cover some testimonials from customers. So I got an email from Eli. Eli said, "Hi, Franz. A sincere thank you is in order. I'm changing careers at the end of this month and preparing for my Series 7 exam. I'm currently in the hospitality industry and venturing into the financial advisory world in June. Your podcast has been the perfect learning conduit for my hour drive to and from work. I'm currently on lesson 31 and thoroughly enjoyed the learning so far. Studying in the evening after listening to the material you discuss in the podcast has drastically improved my retention and comprehension. I'm reading the Nick Murray book, Simple Wealth, Inevitable Wealth. I was wondering if you could recommend any other books for beginners in the industry." And I wrote Eli back and I suggested some books about Warren Buffett. The annual reports from Berkshire Hathaway are great readings. You can get those all online for free. Also, The Intelligent Investor by Benjamin Graham is another great one. And after he did that, he wrote me back and said, "Franz, you'll be happy to know that I took my test and got an 85% on the Series 7. Thanks for all your help. I read The Buffett Way and halfway through The Intelligent Investor. Thanks for the recommendations. Now on to the Series 66 test on November 21st. Then I got an email from Thomas. Thomas said, "Honestly, this is awesome. You put some time into this, and I can only say thank you. It's wonderful to see people helping just to help, not looking to charge $500, such as Kaplan, cough, cough, but really just applying their talents and knowledge with good intentions of hoping it helps someone else down the road. The material is perfect. Being able to apply the concepts from the books to your site is beyond helpful. I'll be sure to share this with everyone who's taking the Series 7. Thanks for being a good person and a genius, really. Have a good year." I'm not a genius, but thanks, Thomas. I really appreciate it. Then from Susan, said, "Hello, Franz. I listen to your Series 7 podcast daily and took the online quizzes, and they helped me pass the 7. Would you make a few podcasts for the Series 24? Thank you, Susan. Susan, no, I think I'm going to do the 65 next. If I do another series of lessons, it's going to be the 65. But I've got another announcement in just a second about another product that I've got out that you may want to take a look at. And then from John, I just wanted to drop you a quick note to say thank you for creating this material. I listened during my daily commute each day. It was extremely helpful in explaining a lot of the concepts I had been studying through my firm's material. I passed the exam yesterday, and I don't think I could have done it without the material. If you do update this material anytime soon, just a heads up, it seems like suitability has become a much larger portion of the test. And of course, this was back when I had my first edition. I put out a second edition, and yes, I covered that much more in the second edition of the Series 7 preparation guide. All right. I have a new product I want to share with you. I put together a series of audio lessons for the insurance exam, the life health portion of the insurance exam. Now, each state has its own set of, as you remember, as you will learn, if you listen to the Series 7 study guide, in the lessons we talk about insurance. And insurance is regulated at the state level. So each state has its own requirements for the being licensed to sell insurance. But in reality, the life health exam is pretty much the same in every state. It doesn't really vary. Some of the other requirements may vary from state to state, but really the exam's about the same. So I put together a series of audio lessons, 12 hours of audio instructions. There's 26 lessons and 4 review lessons. It's $99.99, but to listeners of this podcast, I will give you a $20 discount, a 20% discount. So if you buy this, you will be taken to a Gumroad site, and it will have in there an offer code. And if you put in the offer code, all in lowercase, series, SERIES, the number 7, podcast, PODCAST, it'll take $20 off it. Now, I'm going to keep this offer open until I get back from my sailing trip. And that would be the middle of September, if I remember to take off the offer code. So I think I'll leave it out there for a couple months. So if you're listening to this podcast after September 15th, 2017, that offer code may or may not work. If I forget to take it off, it'll probably still keep working. This is a one-man show here, guys, so I don't delegate too much to other people to do, and I'm pretty busy taking care of my clients as well. So, this is narrated by Michael Young. And again, just like with the Series 7 study guide, you can listen to this on your iPhone. Here's the table of contents of the lessons is in the description. There's a link to this at the website, series7podcast.com. And also, I will have a tab at the website called Insurance Exam that you can go to and get the link to this. My future podcast or my future series of lessons will probably be on the Series 65. And today the podcast is going to be a sample lesson from the Life Health Exam, the Insurance Exam Audio Study Guide, the Life Health. I'm not sure which one I'll do. I probably will be doing the Introduction to Insurance, which will be the second lesson. It'll be about 30 minutes and 46 seconds in length. So with no more ado, I do want to ask you if you like this podcast. If this podcast or if the lessons have helped you in any way, let me know. Or if I need improvement in areas, let me know. You can write me directly, Franz at series7podcast.com, FRANZ at series7podcast.com, or use a contact form at the website. That makes me feel really good when I help people pass the Series 7 exam, and I'm hoping I'll help people pass the insurance exam now too. All right, with no more ado, let's get on to the sample lesson on insurance.
Welcome to this lesson entitled Introduction to Insurance, Part 1. In this lesson, we're going to talk about many different aspects of what insurance actually is, what it does, what it can do, and what it can't do, and some of the basic underlying principles, the different kinds of insurance, what kind of companies sell insurance, what kind of people sell insurance. Just kind of a basic overview that lays the foundation for things that are going to come later in the course. First, let's ask the most basic question of all. What is insurance? Insurance is an agreement that helps people protect against damage or loss of something due to an event that cannot be predicted. Now that's very important. We're going to talk a little bit more about that later, but there has to be some degree of uncertainty in order for insurance to cover whatever it is. There are many types of insurance, including the following. Homeowners insurance, which protects a house or other property against unexpected damage. Life insurance. This protects a person's income earning potential in case of disability or death. Also something that was not expected. Protects those who are left behind, who are now out of income that was made by someone who was working. Another kind of insurance is automobile insurance, and this just protects a person's vehicle. You can get insurance for your actual car, the cost of repairing or replacing a car when it gets in an accident. And you can also get auto liability insurance, which is going to protect you against things that you do. If you accidentally cause damage to another vehicle or vehicles or people, liability insurance is going to help protect you from that, so that that's not a financially catastrophic event. Insurance is a social service. It works by spreading risk over a large number of people. It counts on the fact that some people will have to use it and some people will not. Everybody pays for it, but only some people will have to use it. If everybody had to use it, the insurer would go bankrupt because there'd be not enough money in order to cover the losses of everyone. So they're counting on probability that even though they're insuring thousands of cars, that only a small percentage of those cars will ever be involved in an accident. And in this way, it helps minimize the risk by drawing on a large pool of people. The larger the pool of people, the more money they've got flowing into their company, and the less likelihood that they'll run out of money by paying too many claims. So giving risk to someone else is also called transfer of risk. It helps individuals, or in some cases businesses, so they do not experience an event that will have catastrophic financial consequences. For example, let's say you get in a car wreck and you total your expensive car. Usually, if you would have to replace that car yourself, you would be out thousands and thousands of dollars, most likely. And unless you are already quite wealthy, this would be a catastrophic financial event from which you might or may not recover. You might have to declare bankruptcy. On the other hand, if you have an auto insurance policy, after you pay some money in deductible, most likely, your insurance company will pay for the repair or replacement of your car, in which case it's still a taxing financial event. There's still some financial impact on yourself, but not nearly to the degree which could happen if you were uninsured. Let's talk about a few different vocabulary words, some terms that you're going to need to know in the discussion going forward. The first is policy owner. We'll also talk about the insured. This is the person who buys a policy from an insurance company in order to benefit. So this is usually the typical person who wants to get auto insurance, life insurance. They're purchasing the policy. They're called the insured. The premium is an amount of money that the policy owner pays or the insured pays, usually on a monthly basis, so that they may have an insurance policy. Now this varies from the kind of insurance that you're getting. It varies from insurance company to insurance company, and most of the time it varies from one insured person to another insured person. For example, when you're doing auto insurance, one person's car is much more expensive than another person's car, and so the premium to insure that car is likely going to be much larger. Also, if you've shown that you're a higher risk, let's say you get in a lot of car accidents, your premiums are most likely going to go up because you're seen as more of a risk, that you're going to cost the company money. The next thing you're going to want to know is the term insurer. Now, the term insurer is just another term for the insurance company. They're the people who provide the policies to the insured, or the policy owners, as they're also called. The next term you're going to want to know is benefit. The benefit is the amount of money the insurer agrees to pay the policy owner when certain events occur. Now, these events vary based on the type of insurance, but it could be things like car accidents, house fires, flooding, or even a death or disability. A benefit can be paid out when a loss is experienced, which is defined as having an asset that experiences a reduction in value. Let me just give you a couple examples. So if you have a car, let's say it's worth $10,000, you get in a car accident and it's going to take thousands of dollars of repairs in order to get that car back into working condition. That means you've experienced a loss. The car is not worth as much as it was before. Same thing with a house. Let's say it's worth $200,000, and then there's a house fire, and the house has large sections of it that are damaged. In that case, you've also experienced a reduction in value of your house, and so you are entitled, if you have insurance, to a benefit. Next, we have the word policy, and this is just a legal contract that spells out the terms of the agreement between the insurer and the insured, such as the amount of the premiums and the amount of the benefits, when certain things are triggered. And that's just going to depend on the individual policy, what's being insured, the price of what's being insured. It's going to depend on a lot of different things. And finally, we have the word claim. And a claim is just a request for payment to the insured after a loss happens. So you get in a car accident, you call up your insurance company and you say, I've gotten a car accident, here are the details, I want to file a claim. When you do that, they'll investigate it and see if you have a valid claim, and if you do, then they will pay out a benefit based on what you have in your insurance policy. So let's move on and talk a little bit about risk. What is risk and how does it define what happens in the insurance game? Now, risk is a daily occurrence and it's a universal hazard. Everybody has to deal with some element of risk or another. And there's all sorts of things that constitute risk. Injury, personal loss, premature death, loss of employment, damage to property, illness, and disability are all risks that people encounter and are all things that people like to purchase insurance against. Managing risk is the primary reason people purchase insurance. Life is uncertain. They want to make sure that they're going to be okay despite what could happen. Not what will certainly happen, but what might happen. So when you're talking about risk in the insurance business, there are two things that you need to consider. One is that it says that there is a possibility of a loss. And number two, it's uncertain whether or not the loss will happen. So when you're defining risk in insurance terms, both of those things, possibility of the loss and an uncertainty about whether it will happen. Anything that might result in a financial loss poses a risk, but in the terms of insurance, there must also be an element of uncertainty. We'll talk a little bit more of that in a second, but there's not everything that can cause you to lose money is insurable, because not everything has that element of uncertainty. Risk means loss is only one possibility. It must also be possible that no loss will occur. You might get sick, you might get in a car accident, you might have a house fire, but then again, in all likelihood, none of these things will happen, or maybe only one of the three. So there has to be some uncertainty if it's going to be insurable. And there are two kinds of risk that we talk about in insurance. The first type is called pure risk. With this kind of risk, there is only the possibility of loss, without any possibility of gain. For example, the chance of you getting in a car accident. If you get in a car accident, your car is not going to gain in value when you drive it next, but it's going to decline in value. Whenever you drive a car, it's never going to get more valuable. You only can go down. Pure risk is the only kind of insurable risk. The second type of risk is called speculative risk. And this kind of risk means that it's uncertain whether there's going to be a loss or a gain financially. For example, when you're placing a bet in a casino or investing in the stock market, these are kinds of speculative risk. So when you say you go up to a slot machine, you put in a quarter and you pull the lever, it's a speculative risk because you might gain money. If you hit the jackpot, you could gain a lot of money. It's not very likely, but the possibility is still there. You most likely will lose money, but it's not a pure risk because you could either gain or lose. Same with the stock market. When you buy stock, the stock might lose value, in which case that you would lose money, or the stock might gain in value, in which case you would make a profit. You can't insure yourself against speculative risk. It just wouldn't be good business. When we talk about risk, we also need to talk about perils and hazards and what the difference between the two are. Perils and hazards are both things that can cause risk. A peril is an immediate, specific event that causes loss and risk. For example, when a tornado is ripping through a town, the peril is the tornado, as it destroys property and puts lives at risk. That's a peril. If there's a fire going on, the fire is the peril, for example. A hazard is a factor that can cause peril. When talking about insurance, there are three different kinds of hazards that you're going to encounter. They're physical hazards that arise from material, structural, or operational factors of a risky situation. For example, out in front of a building, there's an ice-covered sidewalk that could cause people to slip. It's a physical condition that is causing more risk. It's a hazard because it might cause people to fall and injure themselves, in which case they would have to pay medical bills and might need to use their insurance. There are moral hazards, and these are caused by people's habits and values, or the lack thereof. A person who lies and so puts another person in harm's way is an example of a moral hazard. For example, if there were somebody who's inspecting a vehicle and they said, "Oh, I did the inspection and everything looks great," but they really kind of turned a blind eye to a potential problem, this is a moral hazard because of their dishonesty, they put somebody at risk. When they drive that vehicle, there's a chance that whatever was wrong might cause an accident, resulting in property damage, injury, or even loss of life. And the third kind of hazard is a morale hazard. Not a moral hazard, but a morale hazard. And these are caused by human negligence or irresponsibility. For example, a construction worker who fails to take proper safety precautions on the job site. Let's say he doesn't wear his hard hat when he's going to work, and something falls, hits him in the head. That was because he was being negligent and irresponsible. The injury to him is far greater. He's putting himself at risk by not wearing the proper safety equipment. Now that we've talked a little bit about what risk is and what it's not, and what kind of risk is insurable, let's talk about ways that insurance companies, individuals, and businesses manage risk. Now, there are many ways to manage risk, and the method that's best to use depends on the situation. I'm going to briefly talk about the 5 major risk management strategies that can be remembered by using the acronym STAR. That's STARR. So two R's in STAR. The first is sharing, S. When risk cannot be avoided, it can be helpful to share the risk with as many others as possible. In this way, if a loss is experienced, the effects of the loss are shared over multiple people instead of impacting a single person catastrophically. That means that each individual person's loss is much smaller overall, which is often the most desirable outcome when risk truly cannot be avoided. So this is what's often done in insurance companies. You have a large pool of people who are all paying money to the insurance company, and when one person experiences a loss, they just take money from that pool, and no one person has to bear the entire loss themselves. A second way to manage risk is transfer, T. This means giving the risk and the associated loss to another willing party, such as an insurance company. The other party is usually more willing and able to bear the risk than the original party. An insurance company likely has much more at their disposal than any given individual. So by transferring your risk and the associated loss to the insurance company, they are much more able to deal with that. The next one is avoidance, A. This entails avoiding the risky behaviors in the first place so that loss does not occur. For example, a person who avoids driving is not at risk in getting in a car accident. They give up the advantages of having an automobile, but their risk is minimized in this way. So you can think of different ways that you can avoid having risk in the first place if you don't want to deal with the possibility of loss. The next is R, reduction. When the risks can't be avoided, they can often be reduced instead. There are 2 different ways this can happen. The first is reducing the possibility that the loss will occur. The second is reducing the amount of potential loss when it does occur. For example, installing a smoke alarm in a building doesn't make it any less likely that there will be a fire, but it does help reduce the possibility of loss if there is a fire. The sooner somebody is alerted to a fire, the sooner they can either try to put the fire out or call the fire department, and they also have a greater chance to escape without personal injury. So that's a way to say, okay, risk is going to happen, loss is possible, let's do everything we can, take safety precautions in order to either completely avoid incidents of loss or to reduce their impact when they do happen. And the second R is retention. That means doing nothing about the risk. That means you're retaining it. The person simply recognizes that there's a risk and agrees to do things like pay a small deductible if there is a loss. A deductible is just a portion of money that you have to pay before your insurance kicks in. So you just realize, yes, there's going to be risk, there's going to be loss. I accept that, and I'm willing to take the consequences. So once again, that's STARR, sharing, transfer, avoidance, reduction, and retention. Now I want to get into something that's called the law of large numbers, which is something we've touched on a little bit, but I want to go into in a little bit greater detail. This means that an insurance provider assumes the risk for a greater number of people. So as large as possible, honestly. In order to make paying out insurance claims financially feasible, they need to have some idea about how many losses are likely to occur statistically among a certain number of people. They need to be able to predict what they're up against. It's impossible to predict how often loss will occur for an individual. There's no way to do it. But according to the law of large numbers, insurance providers can estimate with some degree of accuracy, at least kind of a ballpark figure, about how many losses will occur in a large group of people over a given period of time. Say they insure 10,000 drivers, and they know, since that's a large group, in a year's time approximately 200 will make automobile claims or something like that. I'm just speculating, but that's saying they're able to then know about how much money they need to set aside for automobile claims because they've got this large pool and they know the statistics about how many people are likely to use it. And that's going to vary in reality, but it will likely be within their estimate. One way that they use these statistics is to decide how much that they need to charge as premiums in order to provide reliable coverage to their clients. So they decide, there'll probably be about this many auto claims, so it's going to cost us about this much money, and we're going to spread the cost out between all of our many clients, and so this is how much we're going to need to charge each individual client in order to make sure we have enough money. Now, the larger the group of individuals, the more accurately a company can predict the number of losses. For example, if you have a company with 5,000 employees and another company of 40,000 employees, the insurance company will be able to make predictions about the losses experienced in the company with 40,000 employees much more accurately. So it's in their best interest to try to find large groups. When talking about large groups, it's also helpful to talk about exposure units. And an exposure unit is an item or a person being insured that is exposed to risk. In life insurance, it is the financial value of a person's life, their employment, their assets, etc. And in car insurance, it's the vehicle. Each individual vehicle is an exposure unit. For the law of large numbers to work, the largest possible number of exposure units should be combined into a single group. And so all of these things are similar. They're all cars, they're all people, they are all the same type of insurable thing, whatever that is. Moving on, let's talk a little bit about insurable interest. Insurable interest says that before something can be insured, the person taking out the policy has to have a legitimate interest in preserving the value of the thing that is being insured. Now that might seem like common sense. Let's take a look at a few examples. This kind of illustrate a little bit more what this means. First, let's consider life insurance. A person is assumed, for purposes of insurable interest, to have an interest in his or her own life. A person is also assumed to have an interest in the lives of immediate family members and other loved ones. These are based on the fact that families typically love each other and are assumed to want to remain together for the purposes of insurance. Interest can also be established between individuals in a business arrangement because the continuance of each business partner's life brings financial gain to the other parties. So then it's assumed if you have some sort of business relationship with someone, say you are partners in a company, then you're also assumed to have an insurable interest in the other person's life. If one business partner were to die, the other partner would want to preserve the financial stability of the company. And so in that case, you also have an insurable interest even though you are not directly related to that person. When talking about life insurance, insurable interest only has to exist at the time when the policy is created, but doesn't necessarily need to exist when a claim against the policy is made when a death occurs. For example, a wife takes out a life insurance policy on her husband. Earlier in life, and their marriage is fine. The husband dies and the husband and wife were estranged at that point. The policy is still in effect. You don't have to prove that there's still an insurable interest at the time the policy is cashed out. The time after a death, even if people were estranged, can be an emotional and difficult time, so there's not going to lay the burden of proving insurable interest on a person at that time. Now, while talking about property or casualty insurance, that's a little bit different. An insurable interest has to exist both at the time the policy is taken out and at the time that the claim is made. It's much easier to determine an insurable interest when talking about property as opposed to human relationships. For example, I can take out an insurance policy on my house and my car, but if I take out an insurance policy and then sell my car, I don't have an insurable interest in the car any longer. That's also the reason that I can take out an insurance policy on my own house, but I can't take out an insurance policy on my neighbor's house because I don't have an insurable interest in his house. So if something were to happen to his house, it would not affect me financially. Insurable interest also determines who may purchase a policy, but it doesn't determine who may benefit from a policy. For example, in a life insurance policy taken out by a wife for her husband, and then the husband dies, a portion of the money can legally be donated to charity, even though that charity does not have an insurable interest in the man. And finally, in this chapter, we're going to talk a little bit about insurable risks. Not every kind of risk is equally insurable. Risks that can be insured all have the same characteristics that make them predictably insurable. The more closely a risk lines up with these characteristics, the more easily it can be predicted and insured. The first is that there must be a large number of homogeneous units, whether these are cars, people, etc., so that there can be a large enough pool of people to share the risk. Homogeneous is just a word that means of the same kind. A large pool of cars, a large pool of houses, or of employees, whatever that may be. So if there's not enough homogeneous units, then it's not going to be insurable because you won't be able to predict how often a loss might occur. There won't be enough people to share the risk. The second one is that the insurance company must be able to measure a loss, which means putting a specific monetary value to the loss. Otherwise, they will not be able to calculate how much premiums and payouts should be. So for example, if you've got a car, it's easy to then appraise the car and say how much it's worth, and then when damage occurs, they're able to assess how much needs to be paid out on that car. You can't get insurance for, say, emotional trauma because you can't easily put a price on that. It's subjective. And so that's not something that you can get insurance for because you can't put a specific monetary value on it. The third one is that loss must be uncertain, which means that the risks are pure risks. There's not going to be any gain possible. If the loss were not uncertain, the insurance company could not stay in business because they would have too much to pay out. They count on some policies just never being cashed out, so the loss has to be uncertain. Number 4, there must be a high chance of economic hardship caused by the loss for something to be able to be insured. For example, you cannot insure a $5 toy car because breaking it would not cause economic hardship, while breaking a $5,000 car would, an actual car. This also means that you can't insure something belonging to someone else. Kind of the example about the neighbor's house again, because if something happened to someone else's property, it doesn't affect you economically. It doesn't cause economic hardship. You can't insure it. It has to be something valuable, something that can lose value, and something that you have a specific economic interest in. And finally, insurance companies couldn't remain solvent if they covered catastrophic perils, which are events that cause widespread loss to many people at once. There's no way to predict or plan for these events. So that's why insurance policies do not cover damage caused by war, floods, earthquake, nuclear fallout, though it is possible to purchase specific policies that do cover some of these areas. For example, you might get homeowners insurance and then buy an additional policy that covers flood damage if you live in an area where floods are common. But this also involves paying a higher premium for additional coverage, especially because these events are so unpredictable. A lot of them have to do with weather or natural disasters, things that you just can't see coming, the insurance company can't plan for, and so they're going to have to make you pay a much higher price in order to get that coverage. Well, that is the end of this lesson today. Let's just go over a little bit about what we talked about. We talked about the definition of insurance and how it has to do with risk. We talked about what risk is, defining it, talking about the difference between pure risk and speculative risk. We talked about perils and hazards as being things that cause risk. We talked about managing risk, the STARR, sharing, transfer, avoidance, reduction, and retention. We talked about the law of large numbers, which helps insurance companies predict about how many losses will occur in a certain large group. We talked about insurable interests, which allow things to be insured that you have a legitimate interest in preserving. We talked about the different kinds of insurable risks, what things are and are not insurable, and how insurance companies determine that. We will continue talking about this introduction to insurance in the next lesson. Thank you for listening.
Thank you for listening. Again, if you want to get the full bundle of insurance exam lessons, over 12 hours of audio instructions, go to the website. The link is gumroad.com/I/WCSIM hashtag. And that'll take you to the link in Gumroad where you can purchase it. At checkout, if you put Series 7 podcast in the offer code box, it'll take $20 off it. So you will be able to get it for $79.99. Thanks for listening. If you have any thoughts, comments, suggestions, please write me, Franz, at series7podcast.com. And if you like this podcast, I'd really appreciate it if you went into the iTunes directory and wrote a review, or whatever. I guess it's now podcast directory. Whatever podcast platform you use to listen to podcasts, wherever you can write a review, I'd really appreciate it. Thank you very much. Keep studying.